Hi, I'm Martin Pring. They say that a picture is worth 1,000 words, but I say that a chart is worth 1,000 pictures. And that's because charts in the financial markets often scream out very important messages that an important or significant trend reversal has taken place or is about to take place. Each month I publish a newsletter called the Intermarket Review, and each issue contains what I call the chart of the month. And that features a market that I think has just turned or is about to turn. So this series of videos aims at presenting these charts of the month. So if you're interested in them, please hit the subscribe button and you'll be brought up to speed on a regular basis. So without more ado, let's go to the chart room and see what's in store for this month. Arguably, the most important inter-asset development to take place in the last few months is the positive breakout for stocks against commodities. Stocks in this case are represented by the S&P Composite and commodities by the CRB Spot Raw Industrials. Data can be found at crbtrader.com. Since the year 2000, this ratio has been trending lower, thereby indicating that equities were being outperformed by industrial commodities. Sometimes this meant stocks were moving up at a slower pace than commodities, 2003 to 2007 for example, at others that they were declining at a faster rate. In this respect, 2002 comes to mind. Now it appears that the tables have turned, at least the primary trend tables, as stocks have been given a clear-cut buy signal vis-à-vis industrial commodity prices. It could mean that stocks are going to rally, but it's also possible that they'll decline, but at a slower rate than commodities. All the ratio is telling us is that commodities are likely to underperform equities on a primary trend basis, and that means for the next 1 or 2 years. In technical analysis, there are signals and there are signals. This one is a very big deal, as it's a quadruple trendline setup. Well, what does that mean? Well, price at any one time is determined by the interaction of many different cycles. Since the various rate of change indicators, or ROCs, shown in this chart reflect differing cycles, a quadruple trendline setup shows a degree of commonality whose combined signal is almost always valid and significant in its trend reversal implications. Remember, the greater the number of time cycles pointing in a specific direction, the stronger the signal. The quadruple part refers to the 3 ROC trendline breaks, and that for the ratio itself. A recent example of the power of this combination developed in 2000, where a similar setup foreshadowed the secular bear market in this relationship. Most important is the fact that the trend line for the ratio itself is a huge one, going back 11 years, and it's been touched or approached on 10 occasions, which gives it even greater validity. So what are the implications of the signal? First, stocks will outperform commodities for an extended period. The buy signal for stocks against commodities tells us nothing about the direction of the equity market, except that it's often a positive one. 2. The bottoming of the ratio indicates a low in stocks or is an early bird warning of a low. There are enough exceptions, though, to be cautious on this, as the bottoming of the ratio often takes place at the tail end of an equity bear market. For example, the ratio was in a positive trend between the time it bottomed in May 1920 and when the S&P itself bottomed in July 1921. The same thing happened between September 74 and December 1974, and September 1981 and August 1982. And this is just part of the list where we see the ratio becoming an early bird warning of the final low in the S&P. 3. Between the low in the ratio and the actual stock market low, defensive stocks outperform. A positive trend for the ratio typically heralds a change in the character of the market, where the relative trend for defensive sectors such as utilities, consumer staples, preferred shares, financials and so forth is positive. To prove that such a character change is taking place right now, look no further than the ratio between inflation and deflation-sensitive stocks in this chart. Not only has the ratio completed a head and shoulders top, but its momentum is declining and is bearish, and the momentum has also violated this uptrend line. I rest my deflationary case. If you enjoyed this chart of the month, you may want to go to Pring.com and download a free sample of our intermarket review, a monthly roundup of the world's principal financial markets with a special emphasis on the US. We also look at global indicators, bonds, precious metals, currencies and international markets using ETFs to execute our strategies as much as possible. You'll find unique indicators and intermarket relationships you cannot find anywhere else. In the meantime, thanks for watching and good luck and good charting. In the meantime, thanks for watching and good luck and good charting.